At its inception, Alive promised to provide all major islands of the Bahamas with superior products and services, and we continue to do that daily. With more than approximately 103,000 subscribers, Alive has changed the telecommunications industry. We consistently stress that Alive is more than just a phone company, but rather a diverse, ever-evolving entity dedicated to fostering meaningful experiences and pioneering groundbreaking technology. At Alive, we believe in promoting the advancement of technology in as many ways possible. Technology impacts every domain of our society: education, sport, community engagement, arts and culture, healthcare, and of course, financial services. Back in November of last year, Alive launched its Smart Innovation Strategy right here in Grand Bahama. Since that time, we have worked diligently to provide innovations in healthcare, civic engagement, and education as part of that agenda. We have also introduced innovations in our business services by launching the most comprehensive and technologically advanced loyalty rewards program in the market, The List, an app-based rewards tool available to both our corporate partners and our subscribers that provides a unique and efficient way to bring both companies together with prospective consumers. 2, an innovative cloud-based push-to-talk tool that can be used across Alive's network anywhere in or out of the country once LTE service is available. We also continue to perfect our ever-evolving and flexible product suite that is designed to give the consumer maximum options at the best value. We are particularly proud of our new postpaid plans and roaming products. Finally, we look forward to completing at the end of this month and upon the 2nd anniversary of our license award, the complete rollout of our network throughout the entire Bahamas. We have achieved much, but we are not resting on our laurels. Last year, we joined the Bahamas Financial Services Board as the exclusive telecommunications partner of their FinTech Working Group. Through our participation in this body, we hope to continue to work with the foremost minds in financial services and law to help the country to prepare for the blockchain and cryptocurrency revolution. This is a unique partnership that is entirely in keeping with the way we do business, to be at the forefront of all new innovations in the marketplace and to bring these innovations to the Bahamian consumer. We are happy to be back in Freeport to deepen our participation in this arena and to be a part of the first Bahamas Blockchain and Cryptocurrency Conference. We look forward to an exciting few days with you all. Thank you.
I believed in all the rest. Now my eyes are open. I finally see, and I believe in best.
Gentlemen, please take your seats so we can begin the afternoon program. Please welcome to the stage our Mistress of Ceremonies, Ms. Shameen Johnson, Investment Officer, Office of the Prime Minister.
Good afternoon, everyone.
Good afternoon.
Welcome back for the final sessions of the day at BBCC. What an exciting and informative morning. We've seen some truly great technology and knowledgeable presenters. We've learned what national and international regulations we need to keep foremost in the mind and the requirements for facilitation of enterprises in the local market according to SEC and GDRP out of the EU. There's still so much more to learn going forward to get this blockchain right when bringing technology to Grand Bahama Island. Now, we will get started with the afternoon program and move along swiftly to get the maximum educational benefits out of our panelists and presenters. Our first panel will address the topic of digital token exchanges. Listen carefully and learn what digital token exchanges are and what they have to do with ICOs. And of course, for those of you who have your blockchain degrees, for sure you will learn something new as well. So without any further delay, let's give our attention to our panel moderator, Stuart Hogner, General Counsel, Bitfinex, who will introduce himself and the panelists. Welcome, Stuart.
Good afternoon. Did everyone hear me? The back? All right, I'm going to take this spot because I can see everyone this way.
I'll take that seat.
I'm going to...
I sit here.
My name's Stuart Hogner. I'm the General Counsel at Bitfinex. I'm going to introduce the topic. I'm going to set the table. I'm going to introduce our presenters. Then I'm going to shut up because they are going to carry the load here. They are a tremendous group. You have an all-star cast before you to talk about this, and I'm going to turn it over to them. So we're here to talk about digital token exchanges. These are the Krakens, the Coinbases, the Binances of the world, and they are the, in a sense, not all of them, but most of them are the on-ramps and off-ramps to cryptocurrency. And they offer, they occupy a sometimes uncomfortable crossroads between a huge industry, huge global movement, in a sense, and the legacy financial system. They're often the first port of call for regulators and law enforcement personnel seeking to combat money laundering and terrorist financing, and that's a critical function. At the same time, they're at the forefront of an industry that places a very high, many of whose members place a very high premium on privacy, and who maybe in some cases very suspicious of state power. So it's a difficult position. Bound up with that is keeping up with global regulatory and legislative changes. The US, and we'll hear from a number of US parties on this panel, are always active in this space, especially in the regulatory space. But lately we've seen different approaches coming out of Canada, Japan, the EU, and we can touch on those as well. And I think in that sense, it's interesting to see the approach that the Bahamas seems keen to take. I think a couple of days ago, one of the panels talked about getting things being right, not first. And I think that's a salutary approach. I think it's a really, really interesting way of going about it. On top of that, layered on top, is commercial realities and the pressure to list all kinds of tokens, every token that comes along, versus being selective or choosier about the tokens that go on your exchange. And then part of the whole mix, not to be overlooked, are security issues and the risk of security breaches and hacks. And I work for an exchange that is uncomfortably familiar with the results and the risks and threats associated with hacking. So that's our table set. I am going to take a minute to give you the biographies of our panelists. Starting to my immediate right is Joel Telpner. He's the head of the FinTech and Blockchain Practice Group at Sullivan & Worcester in New York. He is leading policy initiatives for the Global Blockchain Business Council and the Blockchain Research Institute, so welcome. Dan Viola, who is the head of the Regulatory Defense and Compliance Group at Sadis Goldberg in New York. He has extensive experience in the blockchain space and was formerly a senior compliance examiner for the US Securities and Exchange Commission. Also, it is Dan's birthday today, so he has decided to spend it with you.
Thank you. Thank you.
He's 25.
Happy 32nd birthday. Next is Greg Pepin. Greg's the head of global development at Deltec Bank and Trust here in the Bahamas. He has extensive transactional experience and in 2013 founded Cedrus Capital LLC. He's also, one of the most interesting things about him is that he's a former professional poker player. So, get into a match with him. And finally, last but certainly not least, is Ken Goodwin. Ken's the president of Jeanensis Capital Markets, a boutique capital markets and risk advisory firm in New York. He has also had a senior position at the New York Fed and positions at the Bank of Japan and the Tokyo Stock Exchange. Okay, so close to the end of my spiel. Let's start with you, Dan. You've spoken about the U.S. being overlooked, if I can put it that way, on ICOs. And so let's deal with 3 questions if we can. Why do you think that is? Do the recent comments and pronouncements from the SEC, you're a former SEC guy, do they worsen that or make it better? And how specifically do you think that affects the exchanges and issuers in the space?
Okay. So, great questions. And I'm very honored to be here. Thank you so much for Rhonda for your efforts and inviting me. And I couldn't think of a better place to be on my birthday than the Bahamas. But as a former SEC person, I can tell you that I've had some great opportunity to work with the SEC now in my current position, talking to commissioners and trying to get a best practice understanding of the ICO market. And what I find sometimes that it's difficult is I talk to a lot of our clients that are operating outside of the U.S., and they're very frightened of the SEC. They think that the SEC will close down every ICO, that every ICO is a fraud, that if you get any money from an investor from the U.S., they're going to consider that to be a problem. They're going to ask you to give the money back. So what I find is actually just the opposite. It's more difficult for me to understand the non-U.S. securities laws sometimes. And I've had a unique opportunity to try to work with a lot of different foreign jurisdictions, and they're struggling with the same issues. But the SEC has a very tried and true way to raise money in the United States, typically under Regulation D, Rule 506, under the 33 Act, the 1933 Act. So as long as you follow certain accredited rules and regulations, I think it's actually quite easy to raise money within the United States. But the SEC is not going to come out, in my experience, with any new rules on ICOs. They're just going to continue to enforce the same issues that they've been dealing with, which is, are you actually raising money for some type of effort that you rely on the efforts of others? And if so, you're going to have to comply with the securities laws in the United States. And as I evaluate more and more non-U.S. securities laws, I kind of find the same thing happening. Even in some jurisdictions that are very friendly to ICOs, there's still a reference that if you market that token as an investment opportunity, it's going to be looked upon as a security. So I think if the exchanges get properly regulated, if they're going to trade securities, and there's the alternative trading systems or the national securities exchanges in the U.S., I think we're sort of in a good position. It's just a matter of sort of organizing the approach and determining what you're actually going to trade. Is it actually a pure utility token, which could exist, or is it a security? And if we can determine how to address those issues together, I think the SEC has a nice framework, not just for the U.S. rules, but as a model for other countries as well.
Joel, I know you've done a lot of work on the security side in the States as well. Why don't you jump in on that?
Sure. So, I think by the way, if you haven't checked out Dan's socks, make sure you do.
Bitcoin socks, ladies and gentlemen. Very, very nice.
I think it's helpful to put it in context in that people started to create different types of cryptocurrencies, and one of the needs was to have liquidity for people to be able to buy and sell them. So exchanges formed in different parts of the world to facilitate that market. And then regulators came along and said, well, wait a minute. What are these, tokens or cryptocurrencies? Some of them may be securities. And by the way, if you want to be an exchange and what you're trading is security, you've got to be regulated. Or if what you're trading may be a commodity, then you've got to be regulated. And so all of a sudden, we went from people starting these businesses legitimately saying, I'm going to create a liquid market for tokens, all of a sudden being told, wait a minute, you've got to look at what the tokens are, and you may have to register yourself in the U.S. with the SEC as a securities exchange, or with the CFTC as a commodities exchange. You may have to limit who can access your exchange. Maybe it requires only accredited investors to be able to access your exchange, or qualified purchasers. So the world has started to change pretty quickly, and all of a sudden the crypto exchanges are being told, if you're going to be an exchange, you've got to start to look more like a traditional security exchange or traditional commodity exchange, apply with those regulations, and that, among other things, starts to impose on exchanges ongoing due diligence, maybe AML, KYC obligations for everybody that's accessing the platform. So we're quickly going in, as you said in your introductory remarks, to a very different environment than where we started.
Okay. And the recent comments by various people at the SEC, is that making things clearer, or is it muddying the waters?
Yeah, sure. So last week there was another director of the SEC, Bill Hinman, from the corporate division of finance, the corporate finance division of the SEC, and they made some really good clarifying comments about why certain decentralized coins like Bitcoin and Ethereum would not be considered securities. Again, what I would think would already be obvious, observation, the SEC did clarify it, which was helpful. And I think that the SEC has always been somewhat consistent with how they evaluate coins. And Jay Clayton recently said at the FINRA annual conference in Washington a couple weeks ago that he feels that he's already given good guidance in this area, but sometimes people just don't like the answer they hear, which sometimes happens. But at the end of the day, if you look at someone trying to raise money for a platform that hasn't been built yet, that's going to look like a security, in most everyone's eyes. But if it's an existing platform and you're just basically bringing in a utility token for the use on the platform, there's a very good argument that that's not a security. So I think the recent comments from the SEC are helpful, but just consistent with what they've said in the past.
But there was, by the way, a problem that it also created, because if you read between the lines, and they didn't say this explicitly, but there was a lot of rumors going around as to whether the SEC was going to come out and say Ether is a security. Mm-hmm. And right. I think if the SEC had been asked that question at the time that Ether was initially sold and initially launched, they probably would have said, yeah, it's a security. Yeah. They're raising funds to build a platform that's not yet operational.
It's a great practice point that some of these tokens are securities initially.
Right.
But then they evolve over time.
And that's the problem. Yeah. So let's say you issue a token, everybody says, all right, we can see this is initially security, and then an exchange like yours says, all right, we're going to register with the SEC to become an exchange that is allowed to trade securities. And then all of a sudden, what happens if that token morphs somehow, and it shifts from being treated as a security to perhaps at some point, we don't know exactly what that magic point is, but at some point, what if it shifts now to become a utility?
Yep.
Now all of a sudden, the platform that you've set up to trade a security token is out of sync with the fact that this token has now become a utility. And that is a challenge that we have not yet figured out how to address.
Or Joe, let's say if you have a complex platforms, what I'm seeing now, where you may have both. You may have a security and a utility token. So now that begs the question, and it forces the regulators to look at it from a standpoint. As the technology evolves, the platform is getting a lot more complex. So in that sense, it may require that the due diligence has to be done by the exchange. That's the first line of defense, right? But also the policies have to regulate and have to communicate that what's the difference between that security and utility token. Right. And that's the key right there.
Well, and from a regulatory standpoint, can you combine them together?
Right.
You have to have separate platforms, separate liquidity pools, and we don't know what that's going to look like, but at some point, hopefully, we're going to have clarity on it.
Right.
Yeah.
And I don't think that's such a difficult obstacle. In other words, the discussions that are going to create the next disruption will be, let's have an exchange, quote unquote, that trades utility tokens, and let's have an exchange that trades securities. And it's going to be up to the exchanges to try to determine which is which, and they're going to just request some legal opinions for the securities. They're going to try to get comfortable with that position. And if it's a security, they're going to trade it on the exchange or the alternative trading system. And if for some reason it morphs over time, they'll have to come back in line.
Right.
If it's a Reg D offering, the exchange is going to mandate that a broker-dealer, an intermediary, will vet the purchaser to make sure they're properly accredited with AML and KYC information. So I don't think the framework is that confusing. I think we have the practical solutions. It's just a matter of everybody getting on the same page and seeing how it can work operationally.
And potentially getting some type of guidance as to how we determine when a token has gone from one category to another, which is wishful thinking, but...
Yeah.
Okay, so Ken, I'm glad you jumped in on that one. I have a question for you, and then we'll get Greg into this. So you've done a lot of work in Japan, a lot of senior work in Japan. Give us a compare and contrast. How do you feel, or how do you perceive the approach in the United States versus there's one country of many out there, how people are doing things, how they're doing things in Japan, approaching us either at the FSA level or elsewhere?
Well, I'm not going to be biased towards the SEC. I used to be at the Federal Reserve, which brought me out to Japan, actually. So we used to work directly with the SEC. But also in Japan, the regulatory body that's responsible for this is Japan Financial Service Authority, JFSA. Underneath JFAS, you also have the Security Exchange Surveillance Commission, which is responsible for actually going in and doing the inspections and the examinations for a lot of the broker-dealers. And you know this already because they're your counterparties out there in Japan. JFSA is very critical because they look at banking institutions, they look at broker-dealers, they look at all the financial institutions throughout Japan. What was key with JFSA, and I think the big difference is the way that it was communicated. Japan came out and basically told you exactly where they stood in terms of the blockchain and cryptocurrency. They said it was a security token. They flat out told you up front, this is who we are, this is how we're going to operate. And then they created policies and procedures to help you to actually list on via the JFSA. So now if you're an exchange, you actually have to go in, you have to do an application, and you have to do an onboarding application, a process in place to be registered with the JFSA. The great thing about the registration process is that it allows for them to go in and get information about the exchange itself. It also allows them to see the governance in place, who's actually in controls, the types of individuals who are actually doing the type of work, the type of clients that they're going to onboard, and so forth. So what you have with JFSA, you have this procedure in place that's being done. Some people may argue and say it's a long process, and that's just Japan in nature and culture. But at the same time, what you have is you have a tool in place where you can actually do your due diligence. And what happens with JFSA becomes the first line of defense to protect the citizens against consumer policies, consumer fraud risks, and so forth. So I think that's the big difference that I see maybe, and no offense to the SEC, but I think that's the difference that I saw with JFSA relative to the SEC.
I think the most offensive thing to the SEC, from when I've had discussions with, is when there are organizations that say, you know, we're an exchange. Now, the SEC has a lot of history and rules that pertain to an exchange. You know, from the listing requirements to the cybersecurity controls, to the way orders are placed. There are a lot of security measures involved with an exchange. So if somebody is saying, hey, we're an exchange, just because they can match buyers and sellers, that is completely offensive to years of federal U.S. securities laws. So, and of course the SEC feels like it's completely misleading because the people who are buying and selling on those exchanges expect that there are, you know, additional requirements and protections that aren't there. So they took the, you know, upon themselves to notify everybody in March that these are some exchanges out there that we can't protect you. But I think the SEC misses the point here, is that the people who are exchanging on or operating on the exchange want to be on those exchanges. They want to accept the risk, and they want those you know, immediate executions. So, you know, that's where the regulatory framework is behind. And even Commissioner Clayton of the SEC, the head of the SEC, said, we don't want the technology to sort of slow us down. We want to keep up with the technology. We want our rules to change to be adopted to the blockchain. So they believe in the blockchain. And I think there's a positive outlook for the regulators. But currently it's very clear that there's a mismatch between the technology and the law.
And to your point earlier, Joel, it's does the CFTC take a similar approach when you're talking about exchange of commodities, that kind of thing?
They do. Now, it's a little bit complicated from the CFTC perspective because a commodity in and of itself, if it is traded on a cash basis, may generally be exempt from regulation,
right,
other than for fraud and market manipulation.
Right.
But any type of product that's derived from it, so futures, derivatives, option product, those would be subject to direct CFTC regulation, and to do those products would, for the most part, require an exchange that's regulated in a manner similar to what the SEC does. But that bifurcation is not something that really exists on the security side.
Okay. So, Greg, let's get you involved here. You work at a bank here in Bahamas. The banks are often, not always, but often the lifeblood to some of these exchanges, many of these exchanges, certainly the biggest ones. How, as a sector, how, as a banker, do you choose who to do business with from this sector? You're a development guy. Do you ever get into conflict with your compliance folks on those kinds of onboarding or relationship management things?
That's a good question.
Give us the lay of the land from a bank's perspective.
You want my compliance to hate me, right?
Sorry?
You want my compliance to hate me, right? So it's a good question. The problem there is right now, and it actually you can see when you hear, is Japan has specific regulation. The US has specific regulation. There is no regulation called crypto out there, using the name crypto. Actually, the US said, you know what, an exchange is an MTB, money transmitter business or money service business. An ICO is a security or a commodity. It exists, we're going to just put them in the box where we already have a regulation. The problem is by doing that, a lot of people still believe it's not regulated. It's actually already regulated. And for us, the way we see it, I mean, for me, and it's a normal business like any others. What does it mean for a bank? It means that it goes through the normal process. The problem is, as they said, there is a lot of players in this industry that actually are just trying to take advantage of making quick money. I think there were panelists, Sebastian, that said that, which is true. You have a lot of people like the .com, they came, they put .com and they claim they're the best in the world. So there is more rejection rate probably. There will be more rejection rate, but it has to be seen as a normal business. What it means, if you're an ICO, did you do the job right when it comes to regulation? And is there the real management behind that? And if the companies fill all those boxes, then I don't see any reason why banks would not back that. So that's my position, that I think is the way things are done. It's a business like any others. There's more scrutiny to it because it's a new business. New business means new practice, means new players in this game, so we need to learn more about it. And that's more or less what it is, because I've seen some very weird ICOs to very, very strong and positive, interesting project. There's the entire spectrum. So for us, it's just business as usual with more scrutiny for compliance.
I would venture to say that you're one of the more forward-thinking bankers in this space.
Exactly.
Is Deltec on board with that kind of approach generally? How are you seeing other banks? I mean, other banks are really, we're seeing a lot of de-risking, wholesale. How do you find that approach compared to what you're doing at Deltec?
Well, again, it's not about being forward thinker or not forward thinker. First of all, I'm not the compliance. At the end, compliance decide. But my position, personally, is it's a new way of doing business. It's a new business. It's a new section. There's blockchain company. There's company using the blockchain to raise money. And it's the same assessment. They have to go through the same process. KYC, ML, bio behind the companies. What does every individual do? Where did you get your money? Of course, if you have a kid that is 20 years old and claims he's going to change the world, you're going to ask questions about how do you do that? How will you make it happen? So for us, it's going through the same process. I'm not doing the onboarding personally, so I don't know if we do have some or how many we do if we do have some, but I do know that they will probably go through the same process because, again, there's nothing different. It's like a .com company. There's nothing different. Now, when you talk about the risk, I think it's important to separate the perceived risk and the real risk. The perceived risk is it's blockchain. The real risk is it may be a scam. And that's where the focus has to be, and that's where we have, for any kind of client, blockchain or non-blockchain, we have a strict process where we have to learn our client. We meet the client, we talk with the client. And after that, we can assess what they do, and then it moves to a compliance and NBC, new business, to assess if it's a client we deem comfortable doing business with. That's it.
Can I jump in here a bit?
Please
'Cause
do. I know the
think-
three of you will
Yeah.
also have opinions about the banks, and we want to hear them.
Yeah, because I think you hit on a very good point in terms of looking at the risk. The fraud risk is really when you get back to the basic fraud triangle, and I think we have to go back and look at the fundamentals: perceive opportunities, perceive threats, rationalization, and then you have to look at the drivers behind that. What's driving individuals to actually use blockchain technology? Money, right? We know that the big issue we hear throughout the entire conference is everybody wants to build wealth and they want to have money, right? So money could be a driver in terms of developing fraud. Ideology. The ideology in the blockchain is actually for good, right? It's supposed to be that we're supposed to do this for good. We're supposed to bank the unbanked. That's the original ideology behind it. But the ideology has shifted a bit. And then, of course, coercion. Right? The idea that you are coerced, you're in a group, a specialized group, and you operate in a certain way. And of course, we've had this conversation about ego, right? Ego is the fundamental driver where people feel comfortable, right? They feel comfortable, they reach a certain point. So if you take those basic fundamentals and you apply it to every different pyramid scheme, Bernie Madoff, you can see that during out this stage of Bernie Madoff's scheme, he was going through these different characteristics. You can reapply that again as an assessment in terms of looking at your client base. And this is what we do at Jeanensis. We look at each client base from the standpoint of, do they actually fit within that pyramid scheme? And do they actually have the underlying drivers for MICE, which is the terminology that we use in fraud? So I think that's something that's actually...
and to rebound on what he says, what Kenneth said is, and that's the case for any industry. For example, there's one where you see a lot of easy money fraud is raising funds, investment funds. You have a lot of people that never really have experience in raising money, and they're going to build the fund on a concept, and all of a sudden then you're like, oh, bank with me, everything is going to be okay. And that's where it's very important. Now, everybody has to remember how blockchain, so-called Bitcoin, which was the original thing, was created. It was because in 2008, people lost trust in banks. And somebody somewhere, or some buddies somewhere, decided to say, you know what, we're going to take control of that by taking away the trust, by actually decentralizing the trust, by having a system that doesn't need to go through third parties that actually can screw us. That was the rationale behind that. But the thing is that concept, fortunately or unfortunately, depending on which side you are, actually apply to so many aspects of life today. Some people don't trust their government, some people don't trust their school, some people don't trust their bank. So obviously, all of a sudden, that concept of decentralization becomes very, very useful. That's why it actually came out of the electronic peer-to-peer money that was the term of the white paper of Satoshi Nakamoto to what it is today. But to go back just about the regulation on when I was hearing all you guys talking, personally, what I do like about the blockchain is the accessibility of capital for people to raise money legally, to raise money in a fast manner that doesn't require tons of legal aspect. And what I hope is that we can find a regulation or an adjustment of regulation that exists that allow the person here to raise money without having to pay a lawyer $50K just because he has to file 50 paper when it's just a local stuff.
What's wrong with that?
Careful about that. Okay. Yeah, I know. What's so wrong with that, Greg? Come on.
I don't know.
Seems pretty reasonable to me.
But we can do it lower than 50K.
All right, below 50K.
But that's one thing that would be important is it actually gave back some possibility for people to be able to go on the Ethereum blockchain, on the EOS blockchain that's launching, to be able to issue a security. And again, you can register it, but that would be good, for example, to have a regulation that allows small businesses to be able to do it in an affordable manner and be able to get their friends and family to invest in it, because all the regulation you talk here is for a accredited investor. How many people have $1 million to invest? Not everybody. And that's where it could be important, because you have a technology that is open to people, which is what it is, to make a regulation that allow people to do it too. And that's something that would be important to implement at one point in time, because all of these things concern institutional. And I think it would be good to come back to that, because that's what that opportunity is here.
Right.
But by the way, in the U.S., there are crowdfunding regulations that allow people to raise small amounts of money and go after individual investors that don't have to be accredited investors. And so, in theory, that framework exists, and you can use that in the crypto space as well. I mean, those regulations have some challenges in that they've proven to have some administrative burdens that a lot of early-stage companies have found to be not worthwhile, but at least theoretically, we do have a regulatory regime that would allow you to do that right now.
I agree, but there's, as you said, a lot of administrative burden that can scare a lot of entrepreneurs.
Yeah, but if I could jump into this here, because I was at the Fed when the market collapsed. I was part of the TARP team.
This was the right place to be at that time.
Right place. Yeah. And actually, I was part of the term asset-backed liquidity facility team, which was the team that actually provided the liquidity in the marketplace. And what most people didn't realize is that you had all these banks that were triple leverage. And when we say triple leverage, the average leverage ratio is between 5 to 10%. So times that by 3. So you shoot away your balance sheet. So half of your balance sheet, 1/3 of your balance sheet is gone. Banks were not lending to each other. So when banks don't lend to each other, what happens is it doesn't trickle down to the consumers, right? So everything just stops. So there's no liquidity flowing whatsoever. And I remember the day on that Friday when the market collapsed, I was in the compliance legal office, and the general counsel, Tom Baxter, runs down. He said, look, you guys can't leave. The reason why you can't leave, look outside, because outside you have all these black cars, and then all those black cars are the CEO of major banks. Those CEOs running up to 33 Maiden Lane to see Tim Geithner, my former boss, telling them the truth about what actually happens in the marketplace. That our position is a lot worse than what the security is actually, what the stock market is really showing. So what we did was we had to go around the clock to create TALF. And TALF is, we think of the blockchain system, we actually created a private marketplace. We took a bond, we said we're going to price the bond by ourselves on a day-to-day basis, and we're going to designate primary dealers. Those primary dealers were major banks. Their jobs was to actually bring on new clients. Those clients were asset managers. Tiger Asset Management Fund, Rosedale Capital, right? These are names that you're familiar with, Abacus. So those banks were responsible for bringing those particular clients on board to a system. And we had to use KYC, enhanced due diligence, and everything else. So when I think of the actual blockchain system itself, it is in a closed system, but I think that the technology, the blueprint was already there already.
Yeah, yes, but there's one thing that I tend to say, and again, that's my own opinion. What is amazing, one of the reasons banks doesn't like blockchain, when you hear about banks, is because banks make money on inefficiency. Blockchain solve inefficiency. That's a fact.
That's not true.
And
here's where I disrespectfully disagree with you. Banks have been doing blockchain research for almost 3 years and more.
That's true.
They've been private blockchain systems. So what you're finding with banks are coming out with their own blockchain tech uses. So what you see with HSBC just did a trade finance transaction. JP Morgan has their own blockchain research. Goldman Sachs is going to be doing trading, crypto asset trading. So they've been doing this for a period of time. So I think the major banks are realizing that if they're not part of the system, they're going to be excluded. Yeah, that's the question.
Yes, but again, that's because the market became big and they see that they're missing the money. But at the beginning, when they saw the technology, they didn't want about it. Again, money talks. So to go back, the thing is, 2008, blockchain, when there were the crisis 2008, one of the reasons you've seen that leverage is because there were a lack of transparency. And everybody started to discover that there was something called off-balance sheet, and everybody was doing crazy stuff with credit default swapping, etc. One of the hopes you could have if one day everybody is on blockchain and ledger, that you can't really do that anymore because everything become public. You can't have a Goldman Sachs that actually sell you a product and go short, meaning against it, on the right hand while they're selling it on the left hand. That's one of the concepts that is interesting. But that's also one of the concepts that has to be taken into account when you do regulation. You have a system that is transparent. You have a system that is open. You have to take that into account because one of the reasons you have such a heavy regulation is the lack of transparency. You don't know what a company does except when they issue a quarterly update. Here, the system can allow you to be transparent if it's used wisely, which is why I think the regulation has to think about that aspect and maybe build something around conditions surrounding the technology that can actually take away some of the regulation in exchange of what the technology can bring.
No, it's a good discussion. I think it's good to always think back to the origins of this technology and how things get started, and equally why. So Dan, Joel, jump in on let's pivot back just to the banking specifically. I know you guys have had indirect, if not direct, but certainly through your clients, indirect exposure to how banks are perceiving things, what they want to see. Jump in on that and talk about the lay of the land as far as banking is concerned.
Sure. So I think the banks have really decided to reevaluate blockchain to really support their infrastructure now, because they realize that even in the United States there's a lot of unbankable people that these virtual currencies can support. And I know their major governments are evaluating the use of the blockchain and how they can actually tokenize a lot of their services, which is a wonderful thing. And I think that no one would ever argue with efficiency and trying to reduce costs by eliminating the middle person in the equation. I mean, nobody likes to pay a $35 wire fee and a $25 wire fee to receive the wire. Everybody would agree with that. And the way you reduce those inefficiencies is you have a blockchain technology that supports the process. So I see banks, really trying to get more involved. Sometimes I get questions from clients that have, dual associated members with banks and broker-dealers on how they should, evaluate the virtual currency internally. Should it be a security to them? Would they have to monitor the purchases and sales? The best practice there is to treat the coins as securities for monitoring purposes. So you have sort of a divergent application. You see the CFTC sometimes argue, hey, we have jurisdiction over these virtual coins. But the reality is, if you're just trading in the spot market, and you're not doing a forward contract or some sort of future contract or option on the future on that virtual commodity, then the NFA or the CFTC does not have jurisdiction. Similarly, is it offered in a package as an investment? Then maybe it looks more like a security. And the only question and comment that I would sort of address, be careful what you wish for sometimes, because when you talk about whether the SEC jurisdiction applies or the CFTC, there's also these money transmitter rules, and there's bit licenses, that monitor the currencies in the states. And every state has a different requirement. So I find sometimes, as a practicing securities attorney on the regulatory and compliance side, let's find the best possible path that doesn't give us too much regulatory burden. So that's the way we always approach, that type of issue. We don't want our clients to be overregulated.
So right now we have a big friction in the market. If we look at a typical ICO, maybe somebody goes out and, God bless them, they raise 40 million in Ether. Now they're sitting on this pot of Ether, and they may use the Ether to pay some of their vendors, some of their advisors, but at some point, that enterprise says, well, wait a minute, we've still got to interact with the old-fashioned physical world. And that means that part of the world wants to receive payment in the form of fiat currency. And that's where the friction comes, because a blockchain company will go and say to a bank, I've got all this Ether, I need dollars. And the bank will say, no, wait a minute. And they'll start to ask questions, what did you do for AML and KYC? And so what we're seeing, as we talked about yesterday, the market shifting where ICO issuers are now being more cognizant of the needs to do KYC and AML in order to be able to satisfy a bank so that perhaps they can open an account with a bank. But one of the issues that still exists, I'm going to actually ask you, if I can, a question about this, because a lot of those ICO issuers will say...
These people are here to hear you guys, not me.
Well, it's my prerogative. I'm lucky.
I appreciate it.
But a lot of the ICO issuers will say, look, I've done KYC and AML when I sold my tokens, but I can't do anything beyond that. I mean, I can't control where the tokens go. I can't control what exchanges they get listed on. I can't control what an exchange is doing, so I don't know, anything about any subsequent buyers. I don't know about what's going on for KYC, AML. And so from a bank's perspective, a bank is saying, look, okay, I understand that you, ICO issuer, maybe you did KYC, AML, but you're part of this crypto ecosystem. And when you're opening an account with me, I'm not just looking at what you did, I'm looking at the entire ecosystem, and that's part of the friction.
Yeah, look, I couldn't agree more. And to a certain extent, you've got exchanges pointing at the issuers saying,
Right.
what did you do? And then they're pointing the finger right back at them.
Right.
And I think that the responsible exchanges out there, and I know there are bad actors. There's bad actors all over this industry. There's no question of that. But I think the responsible good exchanges out there are doing the KYC that they need to do, are open to regulation, are actively regulated, are monitoring these developments worldwide, and are trying to do the best they can sometimes in conditions where their obligations aren't exactly clear. And I think, speaking for Bitfinex, we have tried to, as much as possible, lead the way. And I think we've got compliance procedures as far as our verified customers that are second to none. And if you are not verified, you've got a limited suite of options that you can do certain things on the exchange, but not others. So I think it's a fair question. I think it's a legitimate one, and I think the good exchanges out there are addressing that.
But I think the more that happens, the more we'll start to see the barrier between the crypto space and banks and financial institutions start to go away. And we'll also start to see more comfort on the side of the institutional money that's still largely sitting on the sidelines.
I agree with that.
Being more willing to come into this space and get directly involved. And so it's part of the maturation process going on, and we are getting there.
I agree with that too. I think you see companies going through their FinCEN examinations, their BSA examinations in the United States, and I think coming through that well. And I just bottom line agree with you there. Okay, any questions from the audience at this point? Madam. Okay, the question was, what's the difference between a utility token and a security token? Gentlemen, anyone want to jump in?
That is the $1 billion question that is going around every jurisdiction today.
Yeah.
So there is many schools. Like I said, for example, the SEC will say if you are raising money for a platform that does not exist, or for something that does not exist, software or platform, it's a security token. If you're raising money on a platform that's already existing to be able to access that platform, it's a utility token. Some other will say, I'm actually just pre-selling my revenue the same way you can pre-sell your cupcakes before you bake them. And so there is still that vision. The regulators now put everything under security token when the platform does not exist. Some others leave, I guess, some sandbox would be the right term. But that's where the biggest problem, and I think they will confirm, that is where the big problem is where does the line draw? Because as Joel said, if you say that the platform does not exist and it's a security token, but then once the platform exists, it turns into a utility token. Because now the platform is here and the token is used to be on the platform. So that's where there's still a debate in the major jurisdiction on taking a stance on it that is clear.
Yeah, I mean, it's important to mention that every country looks at it differently, and so even if we could give you a concrete answer vis-a-vis the U.S., for example, it doesn't mean that other countries would adopt the same thing. But just as you said, one of the ways to think about it is when you're looking at a security, you don't typically take a share of IBM and walk into Starbucks and say, I'd like to buy a cup of coffee with this. Tokens, at least by the time that you have a functional blockchain platform, have a consumptive feature. You're using them to spend or to get access as a membership or to buy a service. And so one of the ways to think about it is the more a token starts to be able to be usable in that consumptive quality, as opposed to simply having to hold this token as a passive investment, the more likely it is that different regimes will start to say, all right, whether we call it a utility or something else, we don't necessarily have to regulate it as a security.
The example, and you'll correct me if I'm wrong, one of the way you could see it in a simple matter why utility token can be tricky is to go back to the example of the bakery. If you have already a bakery and the cupcake are here and people buy it, they're going to say that's a utility. But if you come and say, I need to buy all the ingredients, so I need to raise money to buy the ingredients, but then because you have that token, you'll be able to take that cupcake, the regulation will say, yeah, but without that money, you could have not done it, so that's a security. And that's where there is this debate, because one could say, yeah, but they're just buying it in advance. And that's where the trick could be, for example, on that specific utility token aspect.
I think it's actually really simple. I think there's a lot of debate about the Howey test, which is a U.S. Supreme Court case, 1946, where they tried to apply, a standard, and there've been a litany of cases from there as well. And they applied this test where if somebody is investing money and they had the expectation of profits from the efforts of others, then that's going to make it to be a security, which is all nice. But then there's debates about the facts. So it's a fact-sensitive analysis. But there's a real practical way to figure out if it's a utility token or a security, and that's the way it's marketed, the way people actually hold it out. If you're saying to somebody, we're doing a pre-sale round and this is a great investment for you, that's a security.
You're going to make a lot of money.
Okay?
Right.
It's a security. You're not going to get any regulator, not just the U.S., but even a regulator, who's very friendly with the process. And
No, if you're using the word investment, I mean, yeah.
yeah, if you're saying
You're
this is an
inviting that.
investment, and and we think you should hold this for the long term, and we're going to be a great asset for you. And by the way, we're a utility token for regulatory. It doesn't work that way.
Yeah.
So that's sort of a practical way to approach it. And if you look at the case law, even in the SEC's guidance, they talk about how important it is the way you hold this opportunity out to investors or purchasers if it's a utility token.
So Bill Hinman, the Director of Corporate Finance, when he gave his speech last week, gave, I think, a fairly classic example. He said, if you buy a membership in a golf course, and then you sell that membership and you sell it for more than you've paid for it, you make a profit. And the fact that you can sell that golf course membership interest doesn't make it a security. But if, on the other hand, you buy a membership interest before the golf course has been built, and the money that you're putting in is going to be used to build that golf course, and you're relying on somebody else to build it, and all you're doing is sitting there saying, I hope this happens. I hope it happens. I hope this membership that I paid for in advance actually has value to me, and I hope someday I can profit from it. That becomes the classic example of a distinction between what might be a so-called utility and what might be a so-called security.
And I don't agree every time the SEC comes out with these decisions. A lot of times the SEC makes these, cases to appear to be the law, and then they put out a press release. I think there was the Munchie case, which is a very good case to evaluate, where there was a platform that was being built and it wasn't finalized, but people were going to buy the tokens to utilize the Munchie platform, which was going to be a food service, review platform. Had that platform been built in some version, that could be used in some version, maybe a beta version that you could actually use. Maybe that was a case the SEC would have lost had it gone to a court.
But Munchie was out there saying this is a great investment. They were targeting the crypto investor community, not future customers of their platform. They were even talking about how they would burn tokens to support value and liquidity if they needed to. And
They made a full investment case.
Yeah.
No, I mean, because now you start to see people that actually don't want to do security token because they don't want to go through the burden of all the paperwork. So they're making it as a utility, but when they pitch it to you, they pretty much tell you it's a security.
Right.
But if it's a utility, and that's clearly, again, that's because there's not clear guidelines, but maybe also a lot of people are scared of that regulatory burden that is out there. And it would be interesting to just point to one thing, because we're talking about the US, we're talking about Japan, but we are in Bahamas. And there's one thing that is true, is what you can find out here is the perfect formula has not existed yet, because otherwise all the business will be there. It means that there's still a framework that can be done. And that framework is still up for grab, should I say, because Bermuda tried, it failed. Gibraltar tried, it failed. Barbados is trying, they look to fail. The point is there is still an opportunity out there, and that opportunity needs to be able to answer both the reputational part, the coverage of the risk, and allow business to grow. And that's where we can hope that the Bahamas can be the place where they can take advantage of that, because there could be three opportunities. One, that will bring a new complete market. I mean, let's be realistic. We're now in a situation where in 2000, there was something called the .com, where you had the same trace, a lot of fraud, a lot of scam, a lot of failure, a lot of people that came to try to get quick bucks. 20 years from now, the biggest company in the market, in the NASDAQ, are companies from the .com. That's the biggest market today. There's an entire set of the country in the US that lives on that, the Silicon Valley. Now you have the exact same thing here. The blockchain is not going to go anywhere. It's a new industry that is getting created. There is a place to grab. There is a spot here to grab. Will the Bahamas be strong enough and forward-thinking enough to take it. And then they will have that coming here, which will be used to grow Grand Bahama and any other jurisdiction, any other island. The second thing is the education behind that. What? The answer is yes. Yes. So, and the other thing is the education. The education here, because there are going to be a new round of jobs, and I've talked about that 2 days ago, that's going to come out. And that's where you want to take the position here. And that's what I think is important, is there is an opportunity to be able to learn from what the US is doing, what Japan is doing, what the Bahamas may think, and build something that can answer all those questions the best possible, and get the exchanges to be regulated to actually turn that place into the new blockchain, let's say, El Dorado. And that's something that is important to put in place, and that's why the government did that conference, and hopefully that will lead to that.
We have another question.
Yeah, questions from the audience are best. You don't want to hear me drone on. So that gentleman right there on the edge, and then there's another gentleman right in here. Go ahead.
Good afternoon. I want to get a sense of what the SEC's is leaning more towards as far as cryptocurrency. Because if we keep hearing the reference of its ideology, if we're speaking of the ideology of a cryptocurrency, then we cannot be talking about a centralized cryptocurrency. That in itself is a farce. And if we are going to discuss the SEC, which I think that we should have some regulation, because as Bitfinex has demonstrated, it has the confidence of those buyers and sellers that want to meet at the exchange there. But that would be interesting to know, because if we are going to look for a template, with the Bahamas being a closed loop system and having such high remittances, this would be a wonderful opportunity for us to take the conversation from the higher socioeconomic status and give it to the ground level, and let that organic process which created cryptocurrency in and of itself serve that market. And that's the deficiency that I hear in the conversation. So can you tell me what the SEC is leaning more towards? Because that's inevitably what is going to determine the course that the Bahamas takes, I assume. Please.
I will leave this to the SEC experts, which are to my right.
I'll try. So I think Bill Hinman's comments last week sort of set the stage for how the U.S. would view a virtual currency. The more decentralized the currency, the more it's used by purchasers to buy and sell goods or services, will dictate whether they want to apply a framework of a security around that virtual currency. So, for some of the smaller coins that are being issued in connection with an offering, it's likely that those will continue to be viewed as securities, subject to some sort of exemption under the federal securities laws, or a registration, or Reg A+, or even if you want to do a full-blown registration. And again, I don't think the SEC has been inconsistent with the way they've applied that test.
Yeah, they haven't. I mean, the philosophy, one of the goals of the SEC is to protect individual investors. So how do they do that? They impose on the issuer, the seller of the investment, certain responsibilities. You better provide adequate disclosure, the type of information that an investor would deem material in making an investment decision. You better be responsible to that investor for some ongoing reporting. So it's not just you sell your securities and then you're gone. Investors need to know on an ongoing basis what you're doing, how you're spending your money. So there's an accountability aspect to the regulations. And then the SEC also says in certain cases we expect intermediaries to be brought into the process for purposes of buying and selling and helping to make sure that investors are suitable to make that investment and are expected to perform a quasi-fiduciary role. So if you have an ICO world where you're not treating tokens as securities, I think if you ultimately want to get a regulator like the SEC comfortable with that, there either has to be an alternative regulatory system or at least market practice that's acceptable, in which we're agreeing that there should be appropriate disclosure standards, not the type of inconsistency we see in white papers today. That there should be much more information about who the real founders are, what the corporate structure is behind it. Are they there just to take out tokens, or are they there for the long run? You know, there should be understandings as far as follow-up reporting and financial information. So if we start to see, I think, all of these types of things that one would expect as a market matures, it may be easier in the US and in other jurisdictions to be able to argue that it's okay to have tokens out there that don't have to be treated as securities, because regulators can say, all right, I don't have to worry about investors constantly getting fleeced.
And just to rebound on what Joel said, as you see, it's not that complicated to start to put down a plan that makes sense. You said whatever the SEC is going to do, the Bahamas may follow. How about for once the Bahamas is ahead? Because you're a smaller country, you can go faster than the SEC. Because if the SEC is going to put it in place, it's too late. That's the thing, and what Joel said is common sense. The only thing that we need to do is protect the investor. Either it's in a utility or a security. How do you protect the investor? Transparency. Just put in place some structure to allow an easy transparency that can be managed by smaller business and bigger business in a simple framework of regulation, and allow exchanges to be licensed to bring that liquidity that is still key. And that's all, I mean, it's easy to say, but that's all the general framework that is needed. And we don't need to wait for the SEC for that. We can do it here, I'm assuming, and hopefully it will be done. And that's what I would assume the market looks for. When I talk to ICOs, that's what they look for.
You can do that here. The more places like this start to put out some principles and guidance as far as best practices, and you can get other places to adapt it, that becomes from a bottom-up a way to move it forward.
You can use the US SEC as an example, but I fall back. It's not just the protection of the investor, but it's also protection of your society, of your system. So you have to look at it from a systemic perspective too here, because everyone's talking about investor protection, but you also have to look at in terms of the actual society itself, the risk that you have for your banking institutions. See, very few individuals is talking about the risk that you have for credit, liquidity, market, operational risk, reputational risk. All those things needs to happen at a systemic basis. So you have to be very cognizant to say that this technology may impact other aspects of your operations of your society. So if I was Bahamas, I would take my time and be prudent. Be very prudent and look at practices around the world. Look at those assets that work best for the Bahamas and see whether or not that they need to be digitized. This is a digitized asset. See, we have to go back to technology. It's a digitized asset, and you also have digitized ideas. Separate the two and see whether or not if blockchain technology is going to work in your favor. And if it does work in your favor, then build the laws and regulations in place. If it's a security token, it's very clear if it's a security token. I think by default, it is a security. I mean, Dan brought it out very well. I mean, and the rules and regulations are set in place. But then if it's not a security token, make clear that what a utility token is. So those are the things that you have to do. Take your time and look at yourself and make sure that you have the right policies and procedures in place, because the last thing you want to do is put yourself in a position where you're actually putting on a systemic risk that's going to fall back on firms and fall back on individuals.
Okay. This gentleman?
So I thought I would just add a little bit of insight, because my team and I went to the SEC Town Hall meeting in Atlanta, Georgia. We recorded that and really got some good insight from Jay Clayton and his team about that, because they basically said that at the ICO stage, even if you have a product, it's pretty much a security because you haven't got that decentralization going yet. So when they made the claim that Ether isn't a security, I think we can kind of ascertain from that there are some altcoins that have achieved that stability and that decentralization where they would not be classed as a security. But if you are raising money, even with a product, you should probably go ahead and be proactive rather than reactive and having to spend money fighting the case if you're doing an ICO.
Yeah, as a lawyer that practices against the SEC, it's frustrating because a lot of the commentary that comes from the SEC is very self-serving, which it should be. But you wonder if the courts would agree with the SEC in all the cases that don't go to the higher courts because there's a cost issue. They'd rather settle, and the investors don't want their money to be stuck in return. But sometimes the SEC does take these positions, which you generally agree with, but they're not always right.
And also, when they talked about decentralization, one of the elements of the Howey test is, are you relying on the managerial efforts of others? And so that's their way of saying that if you can argue that the potential value is coming from a distributed community as opposed to a centralized team, perhaps that prong of the Howey test no longer is satisfied. So, I mean, it's not just decentralization, but that is one of the aspects that they look at.
Well, my question is going to be very quick. With respect to blockchain and knowing that it's something you can have transparency and you can see everything that's going on, what about an SOR, self-regulated organization, some sort of standard or best practice? If it's in the blockchain, then if you're not doing it, then investors can go in and see you've not done it and then choose not to invest. So can you comment on that, please?
I've actually had some experience with that very issue, Rhonda. There's been discussions with FINRA, which is the self-regulatory organization that reviews all the member firm broker-dealers in the United States, that perhaps there would be an arbitration division just for disputes involving cryptocurrencies and ICOs. The SEC hasn't really been very focused on it because they've been focused on the fiduciary duty rules and other things that are more important to Jay Clayton's administration. But I think that over the years there's been discussion, not just in this context, but where maybe the FINRA regulator will help support the SEC's regulatory efforts, whether it's regulating investment advisors or trying to supervise some initial coin offerings. But where it stands right now, there is no special SRO for the currency or virtual currency or the ICO market. Maybe there will be.
Yeah, I mean, we're seeing some efforts of organizations like in the States, the Wall Street Blockchain Alliance, which is trying to create momentum from the ground up to create not a formalized SRO, but some type of market regulatory entity similar to maybe SIFMA or ISDA that would start to put out standardized policies and practices and even maybe forms of documentation that the market could opt into. And if one of those initiatives gains traction, I think that'll help quite a bit.
I was just about to say that, Joe, that SIFMA is actually coming out with their next conference, and in their next conference is cryptocurrency, crypto assets, blockchain. So SIFMA represents the industry, and I would imagine that they're going to have some kind of communique about in terms of how corporations and individuals and investors should handle blockchain and cryptocurrency.
I've also heard there's some SEC no action letter guidance, which for those who don't understand the no action letter, is just where you can write to the SEC and say, please don't take any action against me if I take the following course. A lot of people don't like to do it because you put yourself as a target to the SEC. But there are some people who have written to the SEC for no action relief, and I've been told that information will be coming out. So that might help some of the clarifications for the issues too.
Yeah, and Rhonda, as you know, Switzerland, for example, relies a lot more on these types of SROs. So it's not just the states, and there are other countries that seem to integrate them more into the process already, and that have maybe a longer history with those kinds of things too, which is interesting. Next question.
Yes.
And by the way, we're nearing the end of the panel, so maybe this and one other, and then we'll wrap it up. Please go ahead, sir.
Yes, sir. My name is Wayne Johnson, and I represent a company called Goodwin out of Australia. So last year, we launched an ICO here in the Bahamas. Goodwin is registered in Australia. And as we begin to talk about cryptocurrency and blockchain in the Bahamas and the opportunities that exist, you had a lot of Bahamians who saw the white paper, who looked at the executive summary, who went online, got the information, and they was able to make purchases. They got applications, they went to their bank, they began to make purchases. And then all of a sudden, the banks told them they need central bank approval. So I went to the central bank. I looked at the laws of the Bahamas. There was no laws on the book that says it was illegal for Bahamians to purchase cryptocurrency. So what we had was the central bank came to me and told me I need to go to the Securities Commission. So when I went to the Securities Commission and I asked them for a position, I'm not custodying clients' funds. I'm actually giving the clients their applications. The clients are going to their bank. The bank knows who they are. They know they have all their KYC documentation and information. But yet, because there's no regulation, the central bank, they have to go to the central bank to get approval. And I just want to ask you guys with your thoughts, because I have my degree in international business and management, and I've always followed trends, always followed market opportunities. For the Bahamas to be in the position that it's in, I see that if we don't make a position, we will lose out on opportunities, because I have cryptocurrency asset managers contacting me every day. But because I don't know the position of the Bahamas, I have to send them to other jurisdictions. So I would like for you to answer that question in terms of a position of where we need to go, because it's a utility token. It's not a security. It's used in an ecosystem where people purchase goods, services, and the blockchain. And I would like for you all to answer that at that level.
I think there has to be uniformity with all the different agencies. It doesn't do anyone any good to get discourse from different agencies. I always felt the Bahamas Securities Commission was very skilled in this area of evaluating this token and securities, because we actually have a common client that was distributing securities all over the world, and they called them securities in the States, as taking the conservative position. And even though it was considered a security in the States, Bahamas looked at took their time to actually evaluate what was being offered, and said, we don't believe this is a security under our regulations. Returned the filing fee, and said, and again, I don't know what's going to be 3 months from now, or 2 months from now, maybe it have changed. For a government to kind of look at that issue and say, look, even though you're considering a security, we're not going to consider it a security here because it currently doesn't meet our requirements. I think that's very forward-looking, for a government to do that.
Can I focus on just one tiny aspect of your point, which is we haven't talked about custody. One of the challenges, and I think this is where there needs to be, you need to help the government to understand what it means to custody in the crypto world, because part of the regulatory issues that come up is who's got fiduciary responsibilities as a custodian. And so regulators are looking at this the way we think about custodying traditional assets. That clearly is not what we're talking about in the crypto world. And so I think the more government regulators understand that it's a different conceptual idea when we talk about custody of crypto, the more it'll help in getting those approvals.
Yeah, but I think he's really touching on central banking to a certain degree. The use of actually providing goods and services to do a transaction. So what I heard, I think, Dan, you hit it right on point. One of the things that regulators didn't do is come together. See, everyone's talking about the Security Exchange Commission, but you also have a central bank. And that central bank has to decide if that's actually going to be a currency or not a currency. And the key with classifying something as a currency is a challenge, because you're changing the laws, right? You're changing how you operate for a period of time. So let's say, hypothetically, that we go and we say that that's a currency. So if that's a currency, you have issues behind insurance, right? Are they going to insure that transaction? Who owns that transaction? There's fiduciary concerns and so forth. So I think there's a combination of both that needs to occur, where both the security side and the banking side needs to work together and figure it out. Needs to sit back and say to themselves, okay, is this an actual security? If it's a security, let's call it a security. Now, if it's a security, then are we going to allow our banking institutions to participate in the system? If we do allow our banking institution to participate in the system, now what that requires is, okay, we're going to accept your tokens. If we're going to accept your tokens at the banking institutions, those banking institutions have to report. There's a reporting function. There's a regulatory reporting process that needs to be done. Who receives that? Is that done within the SEC? We're here at the Bahamas, or is that done with the central bank? Maybe the central bank receives that. But what you see is now you see this kind of governance that's being created, and you have controls in place that mitigates risk. So I see a combination of both, and I don't see too many too many countries around the world that's actually doing that. That's actually combining them together.
To rebut on what he says is, if it was that easy to figure it out properly, everybody would have already done it. But the reality is, it's not easy. But the opportunity is worth spending the time. That's the thing. And it's probably because it's not easy that there is an opportunity. And that's where I think the mindset should be here is, of course it's not easy, but let's try to do it, because at the end, the success is worth all the problem we have today to try to figure it out the right way. Central bank, Security Commission, government, all of them. But the price is worth the fight. As simple as that.
One last question.
Okay, last question. This gentleman.
Hi, yes. My question is about the banking side of things, the corresponding banking. If you're going to have an exchange set up in the Bahamas, the way I look at it is a bank will need a strong corresponding banking to actually get the money out of the Bahamas into the global ecosystem. So how exactly, I don't know, Deltec or any commercial bank is actually going to do that? Because it seems to be an issue where they're scared to take the first step, from what I understand, because they don't want to be exiled from their corresponding banking, because that's their lifeline. So I would like to know, how can you see that being solved? Because that's probably the biggest issue in this space.
That's a very good question. The answer would be, that's one of the reasons the banks have troubles being able to properly provide a long-term sustainable banking right now for that industry. The main reason is because there is that perception of unclear that correspondent banks are using as a way to restrict transactions. So obviously banks don't want to take the risk because they don't know what will be the outcome of such risk right now. But on the other hand, when you start to see exchanges that are starting to put the right AML KYC in place, when you start to see FinCEN that come out with a letter to the Congress in February saying, hey, it's actually regulated, guys. You just don't know about it. That should kind of ease the process slowly and steadily. But at the end, there is one reality. In 6 months from now, 12 months from now, 18 months from now, 2 years from now, we don't know when. But at one point in time, it's going to become mainstream. So us as a bank, we may not be able to move forward yet. But there's a thing is the government and the jurisdiction, the central bank and the Security Commission can move forward for us. Because at the end, we have limited power. But they do have their own power too. But if we all get together, maybe we'll find a way to make it work. Because at the end, when you see all the government toxins about it, everybody wants to find a way to get that golden opportunity. But nobody had the guts to find the solution yet. And that solution, you know what, once it's going to be found, corresponding bank will be solved. Banking will not be a problem anymore. Raising money will not be a problem. Having people invest will not be a problem because there will be a framework. But at least we'll be able to say there is a framework. Right now, there's none. Even here, we're talking about what the SEC may think. Every week, we don't know if it's a security or not because we don't know what the SEC will think. And we're using a law from a test from what, 46, 48, 1940?
1946.
Okay, we're using it from 1946 when computer did not exist. But again, that's not a problem. It's just that this is how it is now. The problem is crypto world move at a pace that is nowhere near the pace you see now in anything we've seen before. And so it's true that sometimes the crypto world has to be patient to get the traditional world up to speed. But the traditional world has to also accelerate a little bit and take that move and give that opportunity. And that's where your banking issue will be solved.
Yeah, I think what you can do is you can probably, and I'm going to go back I'm going to turn my Fed hat on. You may want to, if central banks are willing to do this, is peg their currency to a cryptocurrency. And what you're doing is you're creating a platform where you have the banks, that's a part of it. So now you have a system, right? And you have a cryptocurrency that's pegged to your fiat currency that allows for you to do transactions on the platforms. So what you're doing is now you're lowering the costs, you're picking up the speed, and you're able to do transactions easily.
And you have done the KYC AML because to issue that currency, you have actually got the KYC of the person that exchanged it to get into the virtual world.
All right, we're going to let that be the last word. Please join me in thanking our panelists today. Greg, Dan, Ken, Joel, you've been marvelous. Just a splendid panel, so thanks, Dan. Oh, and Dan, happy birthday again.
Thank you, gentlemen, for your in-depth commentary. At this time, we're going to take a 5-minute break, but for those persons who are involved with Dr. Moxie's roundtable discussion, that will happen at right now, actually, in Royal Palm 3. So a 5-minute break. We will be back at 3:05 for our next pitch presentation. Thank you.
At its inception, Alive promised to provide all major islands of the Bahamas with superior products and services, and we continue to do that daily. With more than approximately 103,000 subscribers, Alive has changed the telecommunications industry. We consistently stress that Alive is more than just a phone company, but rather a diverse, ever-evolving entity dedicated to fostering meaningful experiences and pioneering groundbreaking technology. At Alive, we believe in promoting the advancement of technology in as many ways possible. Technology impacts every domain of our society: education, sport, community engagement, arts and culture, healthcare, and of course, financial services. Back in November of last year, Alive launched its Smart Innovation Strategy right here in Grand Bahama. Since that time, we have worked diligently to provide innovations in healthcare, civic engagement, and education as part of that agenda. We have also introduced innovations in our business services by launching the most comprehensive and technologically advanced loyalty rewards program in the market, The List, an app-based rewards tool available to both our corporate partners and our subscribers that provides a unique and efficient way to bring both companies together with prospective consumers. 2, an innovative cloud-based push-to-talk tool that can be used across Alive's network anywhere in or out of the country once LTE service is available. We also continue to perfect our ever-evolving and flexible product suite that is designed to give the consumer maximum options at the best value. We are particularly proud of our new postpaid plans and roaming products. Finally, we look forward to completing at the end of this month, and upon the second anniversary of our license award, the complete rollout of our network throughout the entire Bahamas. We have achieved much, but we are not resting on our laurels. Last year, we joined the Bahamas Financial Services Board as the exclusive telecommunications partner of their FinTech Working Group. Through our participation in this body, we hope to continue to work with the foremost minds in financial services and law to help the country to prepare for the blockchain and cryptocurrency revolution. This is a unique partnership that is entirely in keeping with the way we do business, to be at the forefront of all new innovations in the marketplace and to bring these innovations to the Bahamian consumer. We are happy to be back in Freeport to deepen our participation in this arena and to be a part of the first Bahamas Blockchain and Cryptocurrency Conference. We look forward to an exciting few days with you all. Thank you.
I believed in all the rest. Now my eyes are open. I finally see, and I believe in best.